We are half an hour away from the opening bell, the Wednesday session, 30 minutes away, Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm David Ingles. Let's get to your top stories today. Stocks across the region slipping mildly. That's ahead of these key results out of Nvidia. Even after, of course, a record-breaking rally still on Wall Street. Bond traders trimming their bets on 2 Fed rate cuts this year. Now, investigations are underway after severe turbulence aboard a Singapore Airlines flight kills 1 passenger and injures dozens more. Plus, an exclusive with Philippine telco giant Globe Telecom on its latest result and also their plan to transition into what they call a tech-centric company. Happy Wednesday morning from the Asia Pacific. Welcome to the show. Markets are in a holding pattern, frozen in time, if you will, ahead of, well, in between some key conversations around the Fed and Fed officials earlier this morning. Well, Asia time have reiterated the view that, you know, rates are going to remain longer. It's probably a bonus that you'll get a rate cut this year. Effectively, we'll dig deeper into most of the commentary out of this panel early on with bottom of your screens, officials Mester, Collins, and Bostic. That takes us into the other big risk event, of course, in just under 24 hours from now, and reason why perhaps markets are frozen in time is Nvidia, right? Does that earnings story lead us into infinity and beyond, or does it drive us down into this abysmal hole of depression across these markets? Golden Dragon Index overnight, very, very quickly here. Have a look at where we ended the session on the back of Wall Street, ending at a record high, down 2.3%, perhaps mirroring the drop that we had in Greater China yesterday. Very quickly, it's a kind of reminder that Malaysia and Singapore are closed. No A50 futures. You have futures coming online, though, here in Hong Kong, and dollar China, as you can see here, at 724.86 there against the U.S. dollar. Right, so that's the market story. The agenda going into today. So we're keeping an eye on a couple of things, right? So southbound flows were still positive yesterday, even amidst the decline in the equity markets. There are new rules being introduced by the Shanghai exchanges on gold, so that might affect really trading in gold equities, gold-related equities, and gold futures also on your screens. In terms of sectors, EVs, earnings story, right? Li Auto was very bad yesterday, XPeng out, earnings coming through Kuaishou PDD. Data out of visitor arrivals, and a 1 and 5 year bond sale out of CGBs today. Yeah, so we'll see what the next 2 hours holds. Our co-pilot this hour, it's the Engle and English show on the China Show. Stephen Engle, of course, joins us to talk us through these key market themes here.
We pretty much have the same name, don't we?
Pretty much,
Ingles and Engle, yeah. I mean, we're really going to be watching Nvidia. I mean, that's going to be a real bellwether or actually a potential laggard, because the concern, obviously, with Nvidia is they've had this H100 accelerator that has been powering its sales. Yeah. It's likely to be up 243% in the first quarter, or the quarter through April. And, of course, that's just been a boon to the stock and a boon to investors. But, again, the investors are kind of concerned about an air pocket in sales going forward as they are waiting. Some customers, we heard that Amazon is one potential customer holding off on orders of the H100 or other advanced chips, waiting for the Blackwell series of more advanced chips. So, again, we'll have to get the guidance from Nvidia, how they see the sales go.
That's really going to be key, right? Because, you know, arguably, to your point, you know, 3 quarters ago, we could see clearly 3 quarters ahead. Yes. And we see 3 quarters ahead from this point in time, given those earnings, too. And to Steve's point earlier on, right, so you had the likes, for example, of, you know, the iteration of how investors invested around AI in the Asia-Pacific have been in some of the chip stocks in South Korea. So the fortunes are certainly tied to Nvidia, some of the TSMCs of the world, of course, in Taiwan.
Well, look, ASUS, I was just interviewed, I was in Taiwan a couple of days ago. We interviewed the co-CEO of ASUS. They are transitioning almost all their lines of PCs and laptops and servers to AI capabilities. They just launched their first AI laptop. That's going to be a major theme, Michael Dell says yesterday. Of course, all computers by 2025 just about will be having AI capabilities. Yeah. And they need those chips.
They do. But who do they buy it from in bulk is the key question there. Of course, right, now have a look at earnings, you know, as far as the estimates are concerned here. So 24 billion is the median. I think we're looking at 23 to about 27.5 is the range for that. As Steve was pointing out, of course, commentary on Blackwell That's going to be key there as well. Plus, of course, some of the challenges, and some of these chips are actually, which they were able to sell to China, are no longer is no longer a viable avenue, arguably speaking. Nasdaq futures bottom of your screens. Now, in terms of what the market thinks or is pricing Nvidia shares to do post earnings, I mean, so where this stock goes, the stock market goes effectively, it's an 8% swing. One day is where options are pricing this implied move after the earnings. So just stay tuned for fireworks, as they say. So that's about 8%, or 10.5%, of course, from the previous quarter. Right. Let's talk about this in the context of this market that's also rallied here, this part of the world, in Greater China. Yifan Hu, Regional CIO and Head of Asia Pacific Macroeconomics at UBS Global Wealth Management, is here with us in our sets. Good morning. Nice to see you.
Yeah, good morning.
You want to talk about Nvidia? How important is Nvidia?
Yes, it's like one of the major drivers for the tech sector in the U.S. It's also, of course, like a drive the global sentiment.
Right.
So yes, I think it's very important. So of course, we think we are very positive for its a medium and long term. We think the AI the driver. We think that the market will be probably in the 60% of the annual combined growth. So yeah.
So what kind of spillover effect would you think investors are looking for from these results that we're going to get in the Asia Pacific, and how does that impact your projections? Before we go ahead and talk about the bifurcated market, and that is China.
Yeah, sure. I think that for the AI stocks are still one of the most preferred sectors for the investors. But of course, we also suggest for the diversifications. So we can see some medium-sized and small-sized tech, and probably their valuation is much lower. So we think that maybe with this AI driver, and they should be probably a pump out. And also we think the diversification across region. So we also see some of the names in APAC that could also catch the attention of the of the investors. So I think that for this one definitely is one of the key driver for the market.
And it's it's to Steve's point, it was one of the reasons the outperformance of Mag 7 as a group that have, I guess, in some ways proven a good alternative to Chinese markets. That takes me into China, because we're 9 weeks into China outperforming the world. So about 10, 15 weeks into the rally in China, 30% in. How are you advising your clients on exposure right now?
We still see the positive upside, because in the past 3 years, we actually for the China for the sectors down 50 to 70%. Now it's just a start. It's 10 to 15%. So as we mentioned, for example, it's also alternative choices for the investors for the diversification. So last year almost all the markets rallied except for China. So I guess now it's the time for China, because we have the stabilizing growth, and we have more policy, preferential policy come out, and also for the earnings for some of the sectors like tech, actually it's a beat expectation.
So there's obviously been a policy boost for stocks, primarily as policymakers have been emphasizing manufacturing and the industrial side. We saw that Friday with the big data dump for April numbers, essentially industrial production beating expectations. But again, it's the two-speed economy. Retail sales were much worse than expected. So there's the consumer who's still cautious, and then property continues to have lots of problems, whether it's the unwinding of Country Garden or other things. But they are throwing policy at trying to put a bottom of that. Are those still going to be the drags, property and consumption, going forward through the rest of this year?
For consumption-wise, actually last year consumption is the largest contributor to the GDP growth, almost contribute 80%. So we think this year the percent will down, but we still expect 6% of the growth, because for consumption for the first quarter actually is quite resilient, and we think it will also pick up probably in May. One of the major reasons is because we know there's some of the EV subsidies announced in May So in like April, that's like wait and see sentiment. And then we also say we have the excess savings like almost 6 trillion and still at the peak. We think that with the confidence recovery, it will gradually like people like to spend. And also we see the service sectors actually is very strong spending. So as a whole, we think the consumption is very resilient, like at 6%. For the housing side, I think I should say it's almost bottom out because with new policy come out, like demand side, we cut the down payment and also for the like mortgage rates and like relax restrictions. More important, I think it's like for the supply side, I think maybe push the local government to purchase for the affordable housing with the fund because that's very important. We also expect maybe there's some more policy come out in the plenary session in July. In my view, it's possible to set up our like a housing bank. So it's like more like the U.S. style Fannie Mae, Freddie Mac. We buy some like a mortgage MBS, and also it's possible like to provide like maybe the long-term stable like low interest funds to like for some of the like mortgages.
Yeah, which is interesting. Not a lot of people know this. You have a PhD in economics, so I'm going to ask you the economic side to the question here. Some people say this might be China, QE with Chinese characteristics in some ways. Do you think they can pull it off in terms of the unused inventory in the housing market, them asking local governments to come in and buy that, and can China afford it? And is that the right solution too?
Yeah, I think because it's like a domestic, right? So there's also like a need. So what they do is I think they have to be more like probably like a well planned because there's some inventory incompleted. It's already some also finished projects. So I think for the first batch, now currently it's for the buy the like already like finished projects. So it's a 300 billion plus some of the bank loans, so can up to 500 billion. Of course, that's not enough. We also have a lot of like unfinished projects. So I think like one side is more like a commercial housing. So that's actually, as we already say, over 6,000 projects on the white list. So that's like more support by the bank side. Then also, I think that for some of like the housing bank, as I said, like this kind of the housing related like a policy bank could chip in and maybe like purchase and also run for this kind of affordable housing, just like Singapore style, in my view.
Yifan, who of course will be staying with us here on set, UBS Global Wealth Management. Just ahead here, it shows we have an exclusive conversation coming up with the boss at Globe Telecom, one of the biggest telcos, of course, in Southeast Asia. Ernest joins us. A couple of things. They just released earnings. The stock absolute has gone through the ceiling, as you can see. And they've mentioned that they want to pivot, this major pivot, into being a tech-centric company. Stay tuned for that interview just after the opening bell. Also in Manila, counting down to the open of trade. Just over, 17 minutes away. Futures are flat ahead of the open. This is the China Show. Good morning.
This economy has been incredibly resilient, stronger than I expected, and I've been really pleased by how fast inflation has come down in spite of that.
But I think it's a little too soon to determine where inflation necessarily is going. Base case, I do think we're going to have inflation come down, but I think it's going to take longer.
I think this is a moment when, or a period when patience really matters. It's going to take longer for us to see the extent of progress that I think is going to be necessary to change our policy stance.
Frankly, we're not taking a big risk by doing that because so far, the labor market remains very healthy.
Some of the latest commentary there from Fed officials signaling that rates, well, you know what, are probably going to be where they are for longer than most people actually expect. As Christmas, that key point when Santa comes around and delivers that rate hike from Powell and friends. Fix it a days out, 7.1077 against the U.S. dollar. So on the weaker side, effectively, of where it has been in recent days, although based on estimates, of course, still quite wide variance there. Maybe to anchor still this Chinese currency. Still with us on set to talk us through dollar, China, and the Fed. Yifan Hu, Regional CIO, Head of APAC Macroeconomics at UBS Global Wealth Management. Is the Fed important? Because markets have done well despite the Fed not doing anything. So I'm wondering if that's just a bonus at the end of the tunnel.
Of course.
The Fed is important.
And also never go against the Fed. That's also the motto.
Okay, so what does it mean then for asset allocation at this point in time, right? So bonds, for example, yields are generational high still. Equity markets look expensive.
Yeah, I think that overall, globally, we said buy quality. So we still a positive for quality, equities and quality bonds. Quality bonds mean quality IG,
okay.
And also we also happy for this kind of the alternatives because that could provide some diversifications, including this kind of hedge funds or private credit. It's all popular commodity. On the other side, I think they also can provide some hedging, for the portfolio as a whole.
But what is your call on the dot plots as far as when a cut could come? Is September too premature, or is it December? And then again, a completely other side of the coin question, and it's more longer term. What do these tariffs and the potential trade war actually mean for increased steady inflation in the United States?
Okay, so for the Fed cuts, our current view it's still September, 1 to 2 cuts. So I think it's also in line with the market. So for the for the trade tariffs, I think it's not that relevant because I think it's for the U.S. and China, the tariffs is already up to on average 25%, much higher than China with other countries 8%. So I think for the U.S. side, we know the driver of the inflation is mainly service sectors and also shelter. It's not a product side. Product side, actually, the inflation is already started to falling, and but it's more like a service sector. So for the service sectors, for the wage, for the shelter, for the autos, and we still see some of the resilience. So that's reason we think that maybe for the inflation will persistent for a while. But at the same time, I think it's Fed already mentioned that depends on data because we also see some of the softening signs of the job market and also consumption. So I guess as a whole, we still think September has a chance.
Yifan, thank you so much. Hope you brought your umbrella. It's looking moist out there here in Hong Kong today. It's a rainy day. Yifan, thank you so much. Have a great rest of your week. Regional CIO, their head of APAC Macroeconomics at UBS Global Wealth Management. Right, just going into the open today, futures are softer, if not sideways. This was the close yesterday. Just keep that in mind. We were down 3.7%, so we'll see what the update looks like on the other side of this break. Stay with us. It's Hump Day, by the way. This is Bloomberg.
Taiwan is at the epicenter of the world's technology supply chain. Without Taiwan, it would be very difficult for Michael and I to do our jobs. It would be very difficult for us to serve Bill and his company. And so the technology industry depends very heavily on Taiwan and continues to for some time.
Just in case you didn't know who that was, that's Jensen Huang there, Nvidia CEO, speaking exclusively with us earlier this week. Now, somewhat alongside that story, the same theme there, so Bloomberg has learned that Taiwan's TSMC is among the companies that have actually ways to disable the world's top chip-making machines in an emergency situation or scenario such as China, for example, invading the island. Let's get more on the story with James Mager, a China economy editor, to talk us through this. So, James, what exactly do we know about what they're able to do in what kind of scenarios?
The story, what we've reported is that ASML, the Dutch company that makes the lithography machines that TSMC and other companies use, is able to remotely disable those machines, if necessary. The scenario envisioned in the story is that if China was to invade Taiwan, then ASML can stop those machines stop them from being usable for any company that might come afterwards and take over the TSMC factories that are in Taiwan. But I think to think about when you're thinking about this, if China was to invade Taiwan, I think who has control over whatever chip factories survive an actual invasion of Taiwan is probably going to be pretty low on the list of things that we might be thinking about at that time. I mean, that would be just such a massive shock to the global economy and just so destructive for, any number of factories in Taiwan, even if they did survive the invasion with missiles and bombs flying across the island. I think, as I said, I think our concern, people's concern, is going to be less about who has control of these specific machines, and also things like life and death. But even if we are concerned about who has controls of these machines, when you think about TSMC's supply chains, even without a kill switch like this, those factories can't continue to operate for a lengthy period of time without a global supply chain that goes through a number of countries that would be very, very unhappy if China was to invade Taiwan. They have other machinery there. It's not just Dutch companies that are supplying TSMC. It's Japanese companies, it's South Korean companies, it's US companies. And all of those machines that are in those factories need regular maintenance and need regular sort of tinkering by engineers from all of those countries to make those machines work properly. So, if there was to be, God forbid, an invasion of Taiwan, I don't think Japanese companies like Tokyo Electron are going to be sending their engineers to fix the machines at TSMC's factories. I don't think Lam and Applied Materials are going to be doing the same. So even without a kill switch in these lithography machines, the whole supply chain for these semiconductors will very, very rapidly grind to a halt. And no one would be able to make those kinds of chips in Taiwan, even if they did have access to the lithography machines. That's not to say China can't then reverse engineer those machines if they get access to them, but I think the kill switch is a really small part of a broader question.
James, very quickly, does this also lend a lot of credence to the friendshoring trend, where TSMC is building factories in Kumamoto, Japan, they're building factories in Arizona?
I think it does. This is very much de-risking of your supply chain by building factories in other places. I think the part of the concern of that is an invasion of Taiwan, or even just a massive earthquake in Taiwan, which would put these factories out of work for months, or if we saw in Fukushima, factories go out for a long time after huge natural disasters. And so diversifying your supply chains, building factories in Japan, in the US, maybe in Europe as well, is a good thing and will make these supply chains hopefully more stable over time.
James Mager in Beijing for us, our China economy editor, on this fantastic report. Of course, you can check that out on the terminal and also on the internets, plural, if you like it that way. Okay, a couple of stocks that we're tracking ahead of the open here. XPeng is up 9.6, earnings out yesterday. Keep in mind that we were down 10.5% on this stock yesterday, so you split the difference, you do the math, we're still down about 1.9 from 2 days ago. Chips in focus, JD.com, convertibles raising that, and of course Nvidia. Got to talk about that more. Tech in focus. The open is next. This is Bloomberg. Welcome back. You're watching the China Show, counting down to the open of markets here. So far uneventful, and price is certainly reflecting that as well. Cross-asset volatility, actual and not so much implies. But yeah, maybe even implies when you look at the VIX below 12. In a holding pattern ahead, certainly of, you have a rate decision coming out in 30 minutes' time out of the RBNZ. And shortly after that, of course, this press briefing layout, I guess, the rationale of why they did what they will announce they will do in 30 minutes' time. And then it goes into maybe an earnings story, a PDD and Kuaishou in China. And after that, of course, around this time tomorrow, maybe shave off 3 or 4 hours, it's that big event, which is in the form of Nvidia. Anyway, we'll talk more about that in a moment here. Out of the gates, a couple of stocks we're tracking here. I'm just looking at my screen. XPeng is up, so we're looking at 10% on that. More on that in a moment. Their mainland markets are effectively, like perhaps many of you joining us from home, thank you so much, doing absolutely nothing. There we go. China selling 1 and 5 year bonds today, 2025 and 2029 bonds. More on that later on. We're looking at a mixed picture. You're looking at the second row. Those are the heaviest weighted stocks on the CSI 300. Commentary coming through on how you, and change the page please, on how you adjust your exposure 15 weeks, 30% into this Chinese market rally, is you pivot away from some of the growth stocks that have been big winners and into the consumer facing names, discretionary and staples, maybe more on the services side. That's according to Yifan, out of UBS, who joined us a couple of minutes ago. Right, Hong Kong is looking like, again, another boring session here. In the form of data, so we are still in the window for FDI numbers coming out of China. Macau will be releasing the visitor arrivals numbers later today. This is, I believe, is for the April month. Flip the boards, JD.com raising quite a bit of money, convertible bonds, $1.75 billion US. Lenovo was an upgrade, I believe, out of, and my producers are about to help me out, raised to outperform, if I'm not mistaken, there at Morgan CLSA. Anyway, I'm about to have a look at that in a moment there. We're also looking at XPeng, of course. Oh, thank you so much. Morgan Stanley, thank you. Overweight, $15 a share. XPeng, 9% up. Li Auto, horrible day yesterday. 18%, I believe, drop at 1 point. We're flat at the open there. We'll unpack, by the way, the EV story for you this time in the next hour at HSBC. We're talking all things EVs there. And looking at some of the other stocks that we're tracking, Zijin Mining, Zhaojin Mining, and Shandong Gold. So gold mining stocks. The Shanghai Futures Exchange, I think on the back of a move that they made in mid-April, further widened the trading limits to gold contracts, right? So maybe just keep that in mind amidst, of course, where you are as far as this melt up is concerned. Okay, let's have a look at the Philippines now. So that market is also coming online right now. And one of the biggest telcos there, Globe, if not the biggest, actually reported a 7% drop in profit in the first quarter. You have those sort of one-offs there, depreciation, non-cash expenses. Their core income, that was up 13%, 1.3. Morgan Stanley came out, speaking of Morgan Stanley, and upgraded the stock to overweight 1 or 2 days after they released earnings. Let's bring in the boss, the CEO, Ernest, joining us out of Manila to talk us through this. Ernest, First and foremost, good morning. Thank you for making time for us. Let's, I guess, talk about the actual financial targets in a moment. But I want to ask you, and start off, if you don't mind, on Globe's efforts, and you've said that you want to make this a tech-centric company. What does this exactly mean, and what does it also mean as far as resources go?
Well, first of all, thank you for having me, David and Steve. Our pivot has a lot to do with our concern about the maturing telco business. The growth all over the world as far as telco revenues have been challenged. I think it's no secret. Although we did really do very well in our mobile business in the first quarter, growing by 8%, there's this paranoia that we have that one day this will all plateau and be zero growth. And so what we have done over the years is take a look at the different assets we've built as a telco, whether it's the consumer base, the data about consumers, our marketing capabilities, and of course, our human and financial capital, and pivot that into building new businesses, one of which we've been successful at is in the fintech area, where we built GCash into the largest e-wallet in the Philippines. Our objective overall is to bring about a twofold benefit, one for our shareholders in the form of increased stakeholder value, and of course, also benefiting the Filipino people, in the case of GCash, driving financial inclusion. So we continue to do that and continue to look at different sectors like healthcare and others that we can sort of effect through digital means, which is where we have the permission to play.
Right, and if you could extrapolate further into the future for us, really, the piece of the pie, and you mentioned telco as a maturing business, at what point do you see telco actually making up the minority, or the minority of your business and revenues, and might be also, to your point, self-engineered because of this deliberate pivot that you guys are doing at this point in time?
Well, we're not de-emphasizing the telco business. Let's make that clear. It is our main business. It is a very important business. It's a very healthy business. We still continue to derive 52% EBITDA margins from the telco business. It's just that the potential that was sort of promised in the 5G era has not really come about for most operators today. The use cases have been limited, and the hope is that there somewhere, somehow, maybe perhaps with the advent of AI and other edge use cases, that the need for low latency, high speed mobile connectivity will come into being. As far as revenue size, I think it's still quite a ways away. Our fintech business, while profitable and growing tremendously, is still far behind in terms of revenue. However, in market value, we think that it is quickly approaching because the multiples in that segment or in that sector far, are far greater than what we experience today in the telco business.
Well, Ernest, Steve Engle here. Let me jump in and let's talk about your financial services. You mentioned Gcash, which is sort of your e-commerce wallet, and I know Mint, which is the shortened name of your fintech side of the business. Its income contribution going from 4% up to 11%. So clearly there is that transition. But I also, because this is the China show, I'd like to know how that partnership that you inked between Mint and Ant Financial of China, I think it was in 2017, is there a scope there as your Gcash services build out and need more emphasis? What kind of relationship do you see growing with Ant Financial?
Well, the relationship with Ant Financial was really a very, very good one. When we put up the joint venture, our kind of agreement was, give us the platform, and we will take care of building the business. Because that's one of the things we realized early on was that we are not going to be able to build the platform quick enough to meet what the public needs. And so we took the A+ platform that Ant Financial had, which is really the basis for Alipay in China. At that time, they had 600 million people on the platform, and we felt, a platform like that should be stable, should have all of the capabilities that we would need to drive financial inclusion and adoption in the Philippines. And true enough, helped out by the pandemic, which prodded people to try out the app. It really accelerated the adoption after the trial, and we didn't look back, even with the opening of the economy. So it's been a very, very good relationship with them. It continues to be one where we work together towards bringing more value to this company and scaling the company as we build out the rest of the services, the biggest potential of which is in lending.
So, Ernest, if you can reveal, what size stake does Ant have now in Mint, the fintech unit? And do you see that increasing potentially? And what happens if and when there is a Gcash IPO, which you've said in the past you've not had a rush to do so yet. So that's kind of a two-parter. Where will Ant have its position, its stake in Mint? And then what are the prospects for the IPO and Ant's participation?
Well, Ant's share stands around 34% at the moment compared to Globe's 35%. So we are the two dominant shareholders in the business today. And as far as IPO is concerned, I guess from what I've been hearing, and we haven't really discussed it in any detail, is that they intend to hold on to their stake.
Okay, understood. Well, we've been down this road before, Ernest, on this Gcash IPO, and I think Steve just also alluded to the fact that you're not in a rush. I'll try anyway again. Are you in active talks with underwriters on the deal? And also, since you brought it up, I think it was a few months ago, the possibility that you might actually be looking outside to list this outside the Philippine market. Where is your head around this conversation?
Well, our studies continue to unfold. The complications of a dual listing are indeed there. I mean, we've looked at different markets across the world, from the Philippines, US, Singapore, Hong Kong. There is really no perfect market, right? Each market has their own complications. Listing in two markets, whether it's sequentially or simultaneously, also has a lot of issues. You have to, synchronize a lot of the rules, synchronize a lot of trading, periods, and so on and so forth. So it's really, really difficult. I guess I'll repeat what I said. The study continues, but we are gearing up the company to run like a public company, and I'm sure, almost certain that by the third quarter of this year, we will be running like a public company in terms of governance, in terms of the way we run the business, in terms of our reporting. We'll be ready in a push-button mode. Obviously, our preference continues to be to list in the Philippines, where we think that, we believe we are the national champion in terms of fintech in the Philippines, given that Gcash is now used by 94 million users in the country today, and remains, an app that is used at least twice a day by close to over 30 million people.
All right, including me, I should note. Okay. Ernest, how much do you think the company's worth at this point? What do you think the valuation is? Give us a ballpark.
You're putting me in a spot there. Well, let's put it this way. I'll let you do the math, right? We raised money in October, I think, of 2021 at a valuation of $2 billion US. At that time, our user base was around, I think, 30 million or so. We were unprofitable. Today, we're growing, revenues at about 30-35% thereabouts. You could see the income has grown significantly if you just work back the numbers from the net income. And the lending business hasn't even scaled yet. So I'll let you do the math, David.
Right.
Hey, Ernest, can you give us an update on your data center plans? I know you're building another one with a partner. And essentially, how does that dovetail with what the whole world is looking at? And we're going to have Nvidia earn soon, overnight. Again, how does that dovetail with what you want to do with AI?
Well, we think there's going to be significant demand for GPU as a service type of environments, and people will look for locations around the region to host their servers. And we think that the Philippines, as a thesis for our business, is a great location, given it's right in the center of Southeast Asia. We're we're 3 hours from everywhere, pretty much from Singapore, Korea, Tokyo, or Japan for that matter, or even Malaysia and Singapore. So, the latency is perfect. We also looked at Hong Kong has been, now eliminated given its the geopolitics involved there. Singapore has limited space, limited power with which to host data centers. And we think the Philippines is really an ideal location for data centers. So we partnered with a very capable firm, STT GDC, which is part of Singapore Technologies, and of the Temasek Group, and we are building a 124 megawatt data center here in Quezon City in the Philippines, which should begin to operate sometime in Q2 of 2025.
Ernest, you mentioned you just eliminated the Hong Kong option. Just talk us through the risk there. What about perhaps a presence here would you want to avoid, geopolitically speaking?
No, I think a lot of the U.S. companies are now going to be unable to locate in Hong Kong, is really what I meant, right? And so they're going to have to look for alternatives, So the hyperscalers are going to have to look at other geographies, like maybe Indonesia, Philippines, and so on. But we just think we're just placed nicely. Submarine cables are being built. We're expanding our domestic fiber networks that give us the backbone to connect the different data centers we'll be building. And we just think it's an ideal location for these hyperscalers.
So, Ernest, is there going to also, it's kind of dovetailing on that security risk. I mean, I know there's a lot of issues about fraud and things like that, but on geopolitics and national security and data protection, how much more IT security spending are you going to need?
Well, we are one of the biggest spenders in the Philippines today, Steve, and I think that just continues to go up. We have a very strong focus on data security. Obviously, we are the keeper of a large cache of personal information, whether it's in our GCash business or our telco business, and it really is our duty to protect it. And so our board has given us the latitude to invest immensely in cybersecurity.
Ernest, a pleasure to have you. Let's chat again. Run it back, of course. Ernest Koo there, Globe Telecom CEO, joining us exclusively there out of Manila. All right, closer look at markets. 14 minutes into the session here. CSI 300, MSCI China, and your Hong Kong benchmarks looking like this. Excuse me. And we're also just getting a headline coming through. We'll get you more on this in a moment once we have more details. This special local currency government bond, 2.57% coupon here, has been suspended. Will be resuming trade at 10 a.m. This effectively looks like, and just given the time gap between when the headline broke and the time stamp you see on your screens, might be down to a price move or an automatic price move halt is what we're seeing here. Anyway, okay, more on this in a moment. Plenty more ahead. Stay with us. This is Bloomberg. Okay, there's slightly more downside coming through here in Hong Kong, which is typically the case anyway in either direction. CSI 300 effectively flat there. HSBC index 0.4% to the downside. Let's call it modest declines at this point in time. Speaking of declines, one of Wall Street's most prominent bears is actually turning positive. Yep, Morgan Stanley's chief U.S. equity strategist Mike Wilson actually now sees the S&P 500 touching a record high by next June, an about turn, of course, from his earlier view that the benchmark would slip by December. Have a look.
I wouldn't be surprised if we hit both sides. You know, I mean, like, that's kind of the world we're in, which is, you know, think about this year, and we talked about this at the beginning of the year, which is we had three sort of equally similar sort of outcomes. One was a soft landing, just the Goldilocks, which is kind of consensus now, and that's our house view. Then you have the no landing, which is kind of a reacceleration, the stickier inflation, even maybe a stagflationary outcome, which is what the market was thinking about in April. And now you're back to a soft landing, but you still can't rule out a recession either, right? So, like, all of these are very possible, and you know, they could all happen with a higher than normal degree of, you know, certainty. So that's really the headline that should have been out, is that, look, nobody knows anything, right? I mean, and particularly at a point in time, and I think maybe our mistake is just admitting that we don't know as much as maybe everybody else claims to. That's called humility, something that we've learned the hard way over life. But anyways, the point here is that the meat of our report this year, or this update, was really more about how do you make money in an environment where you have basically 0% upside and the base case, and you could have 20% upside or 20% downside. And that's what clients pay us for, right? It's the process. It's understanding, okay, what kind of environment and how are we going to navigate that and manage that? So we spent a large part of the report yesterday talking about trade ideas, specific sector ideas. That's not the headline that people want to write about. That's fine. That's your prerogative. But that's what we want to talk about.
That was never going to fit in the headline. No. We will talk about some of that stuff in just a moment. Let's talk about the headline just briefly.
Sure.
Are you de-emphasizing the 5,400? Are you saying as a price target it's not actually that important to you in a firm? What is that?
Well, it's not important to most clients. Institutional clients don't care about the target on the S&P 500. Let's be honest. Like, they're trying to pick stocks. And look, one of the most important things we talked about in the report is alpha generation this year has been spectacular. The way we measure it with our client base, which is significant, is this is the best alpha generation, alpha capture we've seen since we've started recording it since 2010. So that's what people care about. We're trying to help them in that their process of, okay, what kinds of stocks work in this environment? Oh, by the way, when we skew from these different outcomes, you need to be ready to pivot towards different types of securities. Right now, like, our house call is it's a soft landing Goldilocks outcome. We're not that confident that we want to make that bet fully. Like, we think it's still late cycle, which means quality. Okay, large caps over small caps still. We like staples over discretionary. We have two defensive sectors, overweight, utilities and staples, because that kind of protects against slowing growth risk. So there's a bunch of different things, but the main factor that's been working is quality. Quality's been the most consistent factor, and we don't see that changing.
Are there specific sectors that win regardless of the overall index? Do you see certain areas that are kind of independent of this overall shift of whether there is this momentum in international money that pours in and keeps valuations high and sets them higher?
It's large cap quality. I mean, that is what continues. And by the way, it's not just high growth. It's also cyclicals can work in that, but it's still up the quality curve. And we show it in the note very clearly. I mean, it's been the best carry factor for the last year and a half, which is a classic late cycle winner, which is where we are.
Mike Wilson there with, of course, Morgan Stanley, speaking with Lisa and John in New York. All right, just very briefly, speaking of U.S. markets, so two things are actually, and this is a China angle to the story here. So when you look at, say, short interest in the U.S., we have a story on this, by the way. Short interest on China ETFs, long China ETFs, has picked up. So short positions show waning confidence is the headline on the stock rally. Here in Hong Kong, you have some inverse ETFs that are listed here in the city, and nearly, what, $500 million of inflows total year to date. The bulk of those inflows, in other words, bets or maybe hedges, you could look at them as hedges too, have come in the last month or so. So nearly $450 million of the nearly $500 million of inflows into bearish ETFs have come in amidst the melt-up in prices and amidst the rally that has taken the index to the bottom of your screens, 19,200. Anyway, just some food for thought. Plenty more ahead. This is Bloomberg. All right, we're just looking at some of these movers, tech in particular, the big growth stocks here. So Alibaba, the big news this time yesterday was the cloud business cutting and slashing their service fees by quite a lot, actually. Might not have to do with the stock move you're seeing today. JD.com, that is a convertible story, raising funds, $1.7 billion. HSBC, bottom of your screens. And Xpeng has just been all over the place, really. Like some of my mood swings of late. So it was down substantially yesterday. It has now at 14% up, completely reversed that 10% drop on Tuesday. And the big story out of Xpeng, it's still losing money, but it's narrowing that loss. And we'll talk to HSBC and their coverage team as far as EVs go to talk us through where their take is on Xpeng, Li Auto, and some of these models that are taking place there, where they see consolidation given the price war still taking place in that market. They're also getting their sort of views there on, Tesla introducing a cheaper version. How does that mess with the math and competition there? Is this more than a price war story? Is it really all about also the product lineup of Chinese EVs? Anyway, I'm giving away too much of the secret sauce for later, Steve. Also coming up in the next hour is the RBNZ rate decision. So we're about 5 minutes away from that. No change expected there. And for our Bloomberg clients, have a look at where we are in the Kiwi dollar. Beautiful shot of Wellington. TLIV go on your terminal. Instant analysis when the news breaks in a couple of minutes. This is Bloomberg. Inhale that fresh air. I can almost smell it looking through this HD screen on my screens here. Live shot of Wellington there where we are waiting for the latest RBNZ decision to come out. Kiwi dollar is bids, 61 cents. So in 30 seconds, here comes nothing, quite literally, because no change expected there from all economies. Although it's really about the guidance, really. So the underlying economy obviously hasn't been doing well. Just to contrast that with neighboring Australia, although inflation has come in slightly hotter than expectations recently, so that's complicating the math there. Plus, you have this resurgent Kiwi dollar, and which might actually, a dovish tilt might actually tilt that the other way. Okay, so we're 3 seconds away from that. The cash rate north of 5% as well. We'll get the decision. It has remained at 5.5%. So the RBNZ has left the benchmark rate at 5.5%. We're also looking at, I'm looking at the inflation forecast coming through. Let's start with the average cash rate projection here going into as far as the third quarter of next year. And you know what? There's almost barely any change there. So it seems based on the guidance coming through, using the forecast as a guide, that rates will remain at these levels to 3Q 2025. Okay, at about the same level. Restrictive policy stance is necessary. Forecast for the cash rate for the first quarter of next year is actually, it's actually higher now. Okay, there we go. So they've actually bumped that even higher. Does that mean a rate hike is coming? Okay, a couple of more things coming through here. Okay, I just got to get my head wrapped around this because this is all new information mostly. GDP growth, second quarter 2024, 0.1%. Okay, that's nothing. Annual inflation, 3Q 2024 at 3%. That's elevated. Kiwi dollar is on a rocket, as you can see on your screens. We should also be showing you soon, if we get bonds up, please, just so our viewers can see this melt up. I'm seeing on yields on my screens right now. So the RBNZ cash rate, the track now suggests that cuts are starting later in 2025. But from the current level, it looks like, and I'll correct myself if I'm getting this guidance wrong, it looks like between now and that point, we might actually see an increase in the cash rate. Okay, I'm going to have to revisit this on my screens a bit later on. Anyway, that's a story for now. No change now, change later on in 2025. But the average cash rate of 5.62% is forecasted for next year. Okay, there we go. So slightly higher and then slightly lower from the current level. I mean, if you think about it, the easy path is just do nothing, right? If you're going to hike and then cut. Anyway, more on this, by the way, and perhaps more clarity than I could even give you at this point in time. The man himself, Adrian Orr, in about 60 minutes or so, of course, will be the press briefing. And this time, tomorrow, thereabouts, there is our interview, of course, with the RBNZ governor. You can also tune into your Bloomberg for more on this. TLIV Go. I guarantee you more clarity than I just did on the terminal from our expert editors. Okay, let's look ahead to other mistakes I'm about to do later this week. I'm kidding, of course. Central bank decisions coming out. So we're done with the RBNZ, with Bank Indonesia coming through. And Bank of Korea is going to be interesting, of course, come Thursday. So stay tuned for those. Both are expected to keep rates on Hold. Okay, market-wise, speaking of on hold, we are on hold across these markets ahead of Nvidia, which comes out tomorrow, early morning, Asia time. Asia ex-Japan should be seeing either slightly lower or slightly flat on the benchmark itself. Dead flat, in fact, 0.02%. Also with the S&P, also with the dollar, although the dollar weakness that is coming through slightly might be down to the strength in the Kiwi dollar that has come through literally in the last few seconds or so. Iron ore is a story in and of itself. We're now trading at 122 there on the contract in Singapore, which, by the way, I should note, Singapore is shut. So that's a price as of yesterday. Very quickly, let's look at China and Hong Kong, please, if we can. And the message here is declines. Were declines. Oh, okay, we're now going the opposite way. 0.5% on the Hang Seng Index. We have resumed some gains after the 2% drop that we saw yesterday. Okay, a lot to digest there. Let's bring in Marcella Chow, global macro strategist at JPMorgan Asset Management. Nice to see you. Good morning.
Good morning.
What do I need to think about when it comes to this China rally? 30% in.
Right now, I think tactically it's quite interesting, but then, frankly, we still believe that structurally, for long term, we still remain constructive, but structurally, there are still some hurdles to jumpstart, particularly with regards to like private investment and also with regards to the property market. We do see in terms of the secondary market, property market will look for leading indicators, for example, whether the price declines will stabilize or get shallower, or in terms of volumes, will there be stabilization in terms of that? And also the pass-through, the sales pass-through, will that become more reasonable? Recent data suggests that secondary transactions in terms of sell-through has improved, so we're waiting for more concrete details on that. But for the property sector as a whole, we'll likely need to see more in terms of stable dividend, earnings growth, and also price growth, and also improvement in profit margins for investors to pick up in confidence in that sector. And in private investment as a whole, we'll still need more confidence in that sense as well.
Okay, so we'll need to wait for the fundamental story to eventually follow.
Yes.
So if most of the exposure right now, based on the data, is really in the large cap tech equity at least. Do we broaden out the view now? Do we go into other sectors at this point in time? What is your advice here in terms of specific China exposure?
Right now, we still believe high quality large cap is the preferable way to go.
Okay.
And also structural themes continue to be the way. For example, the shift away from China will continue to shift away from those commoditized manufacturing to more thematic or secular, like carbon transition, or the self-sufficient in terms of technology and hardware and software. So those tech sectors will be the ones we continue to pay attention to.
Marcella, if I can jump in, I understand also you're in the middle of your next review of markets and the economy for June. Is there some snippets you can give us about the bullet point headline?
Yes, actually we are in the midst of writing up our mid-year review, which will be released next month or so. And actually what is surprising is we have been talking about how U.S. economy has been more resilient than expected. But actually within Asia as well, Asian economies have also been more resilient than expected, with 1Q GDP upside surprises from Hong Kong, China, Korea, and also Indonesia.
Right.
And PMI-wise, we see that manufacturing and services, maybe services-wise with the exception of China, both have also, across Asia, have been reaccelerated recently too. So with regards to Asian economies, inflation is also actually remaining quite tepid, and given slow wage growth. And so actually, in terms of inflation-wise, monetary policy for Asia, they are actually not in a rush to hike and actually they can cut at their own pace and to save economic growth if needed. But then I think they're still waiting for the Fed action for the next move.
Marcella, as we await Nvidia earns, I'm just back from Taiwan as well. I did a number of coverage, not only on the inauguration, but on AI and companies there. What's your top line take on the momentum in AI here in Asia Pacific?
Because it's tonight, and I think right now market will remain cautious before the earnings. But then I think, to be frank, we'll need more clearer forward guidance to surprise the market. market. But then in terms of its impact or pass through to Asia, right now, if there is any surprise on the earnings or any beat in revenue, etc., that will suggest sustained demand and provide additional tailwinds for AI-related industries, particularly that will benefit like Korea and Taiwan.
Okay, now if I had to pick between the two, Korea and Taiwan, people use it interchangeably. They're different companies, different parts of the ecosystem.
Taiwan, admittedly, year-to-date has actually increased 17.3%. It's actually the most well-performed market year-to-date, even outperforming MSCI Asia Pacific ex-Japan, which is only up 9.1% year-to-date. Yeah. But then valuation-wise, actually, MSCI Taiwan is a bit expensive right now at around 18.3 times versus its average of around 12.4 times. And right now, for Korea, we continue to believe that the memory cycle upswing and also this AI boost, as well as the value-up reform, will continue to benefit it, both on the value sectors and also the growth sectors. And valuation-wise, is actually quite reasonable at 10.4 times versus its 15-year average of 10 times. So it's very reasonable. And its earnings growth, last time when I came, it was around 77% for 2024. It's been recently revised up again for 2024 earnings growth to 85%. As a comparison, compared to last year-end, people were expecting 2024 earnings growth to be around 51%. So it's still a large jump.
What if Nvidia disappoints?
Yes, indeed, that might be but there might be a short-term retreat and correction for those related industries. But then in the long term, those structural drivers will continue to support AI industries and AI-related sectors.
I think they're talking about a potential, or investors are worried about an air pocket, so to speak, between the orders and expectations from companies like Amazon. They put on pause some of their purchases, the high-end Nvidia accelerators like the H100. They're waiting for the next series, next generation of AI accelerators coming from Nvidia. So I think most of the market agree that it could be a short-term blip downwards after their results. Pivoting then again to macro policy in the U.S., what's your call on the Fed? Is September too premature to say a cut, or is it more towards the end of the year?
Indeed. Recently, with weaker than expected CPI, which we see that Vice Chair Jefferson was actually saying is encouraging, we do see that a market has revised the rate call more towards swing towards September. But we do believe that this might be a bit premature because recently, for example, GDP is far from weak, and then there are still inflation components that remain quite sticky. And also in terms of financial condition, compared to early 2022, it's still relatively easy. So the Fed is actually not in an urgency to ease, but frankly, we'll likely still need to see more data to support this. And for now, we still believe December might be a way to go, but then September might be a close call too.
Can we at least assume that bonds will outperform cash, though? That's the other comparison. So cash strategies versus bond, even if they don't cut, you favor bonds over cash or cash over bonds?
Both stocks and equities over cash for sure.
Okay.
For the next 6 to 9 months. And particularly believe that even though no matter September or December, the Fed next step will likely still be a cut, and it's just probably going to be delayed but not canceled. So rates are still going to come down, and this will continue to benefit. For example, yes, year to date we see that corporate bonds and treasury bonds, given all the rate and also the inflation uncertainty, we see that corporate bonds actually, investment grade and also treasury bonds actually underperform. But then high yield surprisingly outperform. And actually we see that in Asia, Asia high yield outperform was returning 9.1%. 9%, yes, compared to U.S. high yield around 2% year to date, which is decent as well. And this is because of like the solid credit fundamentals and also the better than expected Asian economics outlook, as I was mentioning just now, and also resilient U.S. economic outlook as all like the whole market perceives and understands. And so going forward, I think as you're mentioning about the mid-year and our outlook is that as rates and also inflation uncertainty subside, this will suggest that there will be more potential upside for corporate bonds and treasury bonds, especially they will continue to provide a downside protection to growth in case we still believe that economic fundamentals might weaken going forward. And as for spreads, it will still likely remain tight, but then it will remain quite stable and can remain tight for a bit of time.
Marcella, thank you so much. It was great to see you. Marcella Chow there, global macro market strategist, rather, at JPMorgan. Ooh, the camera's shaking. Not an earthquake, guarantee you. At JPMorgan Asset Management there. Okay, just to recap the breaking news this hour is RBNZ really causing a bit of friction in these markets. The Kiwi dollar is on an absolute tear. Bonds are effectively on offer right now, so we're up 4 basis points on the 3-year yield. The Kiwi dollar is up now 0.9%, which is typically a move you don't see outside of central bank decision days as well. So effectively, we're looking at rate cut expectations getting pushed back based on the forecast, although the latest line coming through out of the statement, I believe here, is that a cut was actually, raising the cash rate at this meeting was actually discussed. There we go. So quite a hawkish tone coming through out of the RBNZ today. Press briefing, top of the next hour. This time tomorrow is our interview with the RBNZ governor. Right, just ahead, here in shows, investigations begin after severe turbulence hits a Singapore Airlines flight, killing 1 passenger and injuring dozens more. An update next. This is Bloomberg. Welcome back to the program here. Live pictures out of Singapore right now. Of course, we're on a holiday as far as cash equities go there. In the city, no doubt, though, the biggest story in town, and you probably heard about this massive turbulence hitting, of course, the Singapore Air flight. The Transport Ministry, to be more specific, is investigating after 1 person was killed, dozens of others injured when a Singair flight from the UK hit severe turbulence. Avril Hong is with us out of Singapore to get us up to speed on all the latest. Yeah, Avril, just get us, what do we know at this point?
Yeah, this is a really unfortunate incident, and I think traumatic to those that were on board the flight. What we know is that Singapore transport authorities are in touch with their Thai counterparts. They're sending investigators to Bangkok, which is where the flight made an emergency landing. We hear how Thai civil aviation authorities, they are also investigating. Singapore Air says that it's working with authorities. There were about 230 people on board the flight. From multiple nationalities, the UK, Australia, Singapore, India even, and it was supposed to be a routine flight, 13-hour journey from London's Heathrow to Singapore's Changi Airport, and it was over Myanmar, the Irrawaddy Basin, that we actually saw this really severe turbulence hit, and that emergency landing in Bangkok had to be made. Passengers describing about how they were in their seats one moment and the next they were hitting the overhead compartments. We saw, images of a lot of items just strewn on the floor. 1 British national was confirmed killed. He's a man in his 70s, and it's believed that he suffered a heart attack. There are also 6 or 7 others that are in critical condition. That's what we know so far.
Well, Avril, it just goes to the point, wear your seatbelt. Obviously, you can't necessarily predict the weather or when you're going to get that kind of turbulence. I know off eastern Japan is some of the most turbulent air in the world. You always wear your seatbelt there. But flying over the continent and flying over Myanmar, is there indications in this investigation? First of all, the airplane acted as it should have. It did not obviously crash. And the crew, I'm sure, and the pilot in the cockpit acted accordingly. But is there investigations into maybe, how climate change and how the weather patterns are affecting and making incidents like this more common?
Yeah, we don't yet know what sort of turbulence actually caused this particular severe incident, but in general, turbulence is caused by pockets of rising hot air, or it could be because of clouds that come with gusts and storms. But the more severe forms include clear air turbulence, and this occurs at higher altitudes. This is something that is practically invisible, so really hard for pilots to see, much less to avoid. And note here that the flight was cruising at around 37,000 altitude. That's really high when this incident occurred. To your point about climate change, we don't quite know yet. It's very difficult to pinpoint climate change to specific flights. That's just because the data is not very comprehensive, and it's really reliant on pilots' records. But we already hearing from atmospheric scientists, they talk about how in the North Atlantic, for example, since the 1970s, I think that's like 50% surge in these clear air turbulence cases, and they expect it to double, even triple in the decades ahead. But even without the climate change impact on air travel, as it cannot be ascertained just yet, we already see how it's affecting travel on the ground even before takeoff. You think about how extreme heat affects the ability of these planes to take off, because as you know, hot air, less dense than cold air, with all these molecules bouncing around, just makes it a lot trickier. So in that sense, we already know how that is affecting air travel, causing more disruption overall, guys.
Fantastic reporting there. Havel Hong in Singapore for us, getting us up to speed. On Avril's last point, you can read up, by the way, on the effects of climate change and what we know so far effectively, and certainly the science is not on climate change, on turbulence to be more specific, before some of you get upset here. Isn't quite all the way to there just yet, but what we know so far, read our quick take on this specific topic today on the terminal. That's quick go without the K for Bloomberg subscribers. Right. Other stories that we're tracking at this point in time, PIMCO is increasing its focus on alternative strategies in its Australian business as it courts the country's fast-growing $2.5 trillion pension industry. The asset manager says alternatives now represent 70% of its Australian institutional business. PIMCO says that reflects a shift in demand from super funds. Now, Blackstone plans to share ownership of companies it buys with a broader group of workers. According to an internal or investor memo seen by Bloomberg, it's launching an equity-linked incentive program for about 18,000 employees at climate tech firm Copeland. Now, the move marks a more direct effort by Blackstone to give workers a shot at equity, of course, in their investments. Now, Disney's Pixar subsidiary is cutting 14% of its staff here as part of its parent's cost-cutting drive. The company says about 175 employees had been laid off. Now, Pixar will refocus on feature films and also move away from producing TV series for the Disney Plus streaming service. Disney CEO Bob Iger wants to cut annual expenses by more than $7 billion. Now, the Thai seafood supplier that actually owns Red Lobster is challenging claims it forced the now bankrupt restaurant chain here to take its products while management pushed a disastrous endless shrimp promotion. Thai Union is disputing a statement from the Red Lobster CEO that the supplier exercised an outsized influence over affairs. Now, this claims left Red Lobster with burdensome supply obligations. Right. Plenty more ahead. This is Bloomberg. Welcome back to the program here. An update on assets in New Zealand following what eventually became a fairly eventful RBNZ meeting coming through. Hawkish, all caps to underscore that, all in bold as well. Italics if you want to be a bit more specific here. Well, effectively is the cash rate, the track now suggests that cuts are starting later next year, so not even this year, so it's more than a few months away. The committee also, and here's the thing, also discussed the possibility of raising the interest rate at this specific meeting. So it's not just hawkish, right? A move was actually discussed. Now, as to what extent, of course, it was, we'll find out, of course, at the press briefing at the top of the next hour out of the RBNZ. For now, that they left things unchanged at 5.5.
Yeah, I mean, as Garfield Reynolds on the Top Live blog essentially saying, Governor Orr once again burnishing his credentials as a believer in staying tough as long as necessary.
There we go. So, yeah, that's really leading to the soaring Kiwi dollar, yields on the way up. Plenty more ahead here in shows. We're talking EVs, China EVs to be more specific. This is Bloomberg. Right, we're just moving into the Tokyo lunch break, a fairly uneventful equity market session, although in the bond markets, and certainly the hawkish tone coming out of Fed speakers, this now tone out of the RBNZ, sending yields higher, not just in New Zealand, and certainly just expectations of inflation is here to stay. In fact, this is something you don't normally see. The 10-year break-even in Japan is actually now at a record high. So you take the nominal, you adjust for inflation, and that's what you get. We're back at the highest level here. And, by the way, we're almost at 1% nominal on the one-year JGB yield. Dollar yen has been behaved itself very tight range of late. 156 thereabouts has been your handle, and declines across both major benchmarks in Japan, 0.6 of 1%. That dovetails into the rest of the region here, where we are mostly seeing weakness, if not sideways trading. It's also worth noting, though, that a lot of markets are shut here in the region today. Singapore, Malaysia, and I believe Thailand's also shut later today, which should be coming on, of course, in the next hour. Now, all that being said, the Chinese markets seem to be doing the lifting today after pulling back yesterday, although upward momentum, you look at some of the technical indicators, do suggest that the upward momentum in the Chinese market, particularly in Hong Kong, still remains largely intact. All right, that's a market story for now, effectively saying nothing is happening. There it goes. Across this market, 60 seconds of me just talking, not so much nonsense, but hopefully helpful context. Okay, the China Chamber of Commerce to the EU, and we're talking tariffs here, it says Beijing may consider raising temporary tariffs here on imported cars for large engines to a maximum of 25%. Now, the trade lobby group refers to an interview published by state newspaper The Global Times, which called for the tariff increase. Chinese EVs are under scrutiny in the EU and in the US as the West accuses China of overcapacity in new energy industries. Yep, that's the, newest chapter or potential newest chapter in this ongoing story here. XPeng, BYD, about an hour into the session, NIO and Li Auto on your screens right now. And XPeng, the reason perhaps you're seeing that most pronouncedly on your screens is out with earnings. It's a smaller or narrower loss. It also was down 10% yesterday, so this just makes up thereabouts of the move, offsets the declines we had yesterday. To talk us through those earnings, the industry, and perhaps what their topics are, HSBC Shanghai Securities Head of China Auto Research, Yuqian Deng, joins us out of Beijing today. Good morning, and thanks for coming on the show. Why don't we start with XPeng? That's certainly the most recent development here. Narrower loss. When do you think the company eventually turns a profit?
Yeah, sure. Great question. So we're still forecasting they're going to be loss-making this year, but the trajectory is the loss-making will be narrowed versus last year, and they are running towards improving trajectory. They're going to have the new model Mona, a smart budget sedan model launched the next month, ramping up starting from third quarter. They're also going to introduce another B segment, which is a mid-sized sedan new model in the fourth quarter. And also, company talked about they're going to have 10 new model lining up since the third quarter this year until 2026. So they are selling into a strong product cycle, and we do see quarter-on-quarter improvement underway. It's still loss-making, but much narrowed, and we expect, along with the product cycle and volume and the scale expansion, the company can gradually break even.
Ingles and Stephen Engle here. I was, of course, up at the Beijing Auto Show, and EVs were everything there, obviously. But again, profitability is a problem across the entire sector. I mean, BYD has 2 cars that they're selling below $11,000 US. There's a massive price war going on right now to get consumers to fork over that kind of money, and that's why a lot of those, as you just mentioned about XPeng, they're coming down from the high end to the mid-range and even lower. So what's it going to take to get profitability at a time when there's a very fierce price war across the industry?
Yeah, sure. We would say the pricing pressure probably part of life now during the process of the consolidation, which is where we are at the moment. And BID chairman do talked about 24, 25, and 26 going to be a tough consolidation year where we see the leaders probably are willing to sacrifice excessive return to accelerate the pricing war or accelerate the consolidation process. So for the near term, it's going to be a profit pool destruction in the near term. But hopefully, when the industry consolidates, we have less survivors. The pricing environment could be getting better, and the industry pricing environment will be getting better. And generally, the profit pool can reconstruct from there. So we're going through this consolidation process. Pricing pressure will be on and off. And but we do believe second quarter the pricing environment is better than the first quarter because BYD is not cutting, and also the demand dynamic is tracking better. And on top of that, government do have the trading subsidy, which help to ease and giving more clarification for the consumers who want to buy.
Well, Yuqian, I'm not sure if you can answer this, but I guess investors who are looking at this sector and wondering where to invest in the supply chain or in the automobile makers, if you're talking about consolidation, who are going to be the winners and who are going to be the losers? Who's going to be squeezed out?
Yeah, so two sides of the implication. So among the OEM, so we do believe BYD will be a clear winner. So they're taking close to 40% market share, and they're disproportionately more dominant in the profit pool, considering a long chain of laggers who are still struggling at loss-making. So they are the clear winner. They basically have the scale, they have the leading technology, and they also have a very practical pricing tactics through this consolidation process. And another implication we want to emphasize would be on the battery leaders, for example, CATL. So we're talking about the last week EV penetration has been breaking 50%. So generally EV is taking more share from the ICE. Therefore, the midstream battery supplier leaders such as CATL would also be able to benefit regardless of who is the OEM winners.
Right. Can I just ask you, since you mentioned BYD, your other topic is Li Auto, you as an HS. You have a buy recommendation in both, if I could just get it out there as well. The earnings which came out, I think, 2 days back, particularly what we're seeing with the mega model, so they've, as you know, they brought down the guidance on deliveries. And the stock had absolutely punished yesterday. I think we're down still a little bit today, if not a little bit higher, 2.7%. Is this a buying opportunity? And I guess you're not concerned over what they said.
I would say yes. They are currently going through a rough patch. Second quarter still remain a little bit more challenging, especially given the recent headcount cuts, and also they've just introduced the price cut for the existing portfolio, and they are also have been ramping up the new model L6. So second quarter remain to be a bit more turbulence, but the silver lining is the first quarter gross margin remained quite healthy, and the job cuts recently might ease the OPEX burden into the second half. So and also the price cut might release the more volume elasticity down the road. So we do expect monthly data point tracking improvement could be the key catalyst down the road.
Yuqian, how do you read the impact on these Chinese OEMs from the prospect of tariffs? The U.S. market is already pretty much non-existent. Now they're going to raise tariffs to 100% to pretty much close the Chinese off from the U.S. So let's look at Europe. They're talking about possibly another 20% tariffs on those Chinese EVs to that market. But then BYD and others, they're going to start making them in Hungary, which is more China-friendly. How do you see this all playing out?
Yeah, sure. Our industry players, the OEMs, has been basically talking about they've been budgeting for potential higher tariff in Europe. But instead, a more important way to mitigate the midterm risk is to build the in-market production. So BYD is opening plants in Hungary, in Europe, and also Thailand, Indonesia, in ASEAN, and also Brazil from South American standing point. And also, this in-market supply could be able to mitigate the risk into the midterm. That's what they've been focused. focusing. And also in the near term, I just want to stress that the volume mainly coming from the emerging markets such as ASEAN or South America. Europe is strategically important, although we still have a little bit uncertainty about the tariff over there. But it's going to be strategically important. But the volume perspective is emerging market at the moment.
Right. Final question for you. And, Steve was, as we mentioned, he was at the auto show. And, I remember to Steve that you mentioned this during the auto show, that just the product lineup that these Chinese EV makers are coming out with is very, very impressive. So, Yuqian, my question for you is, we keep talking about how, lower prices are attracting Chinese consumers. And I'm wondering whether the preference for Chinese models simply goes beyond because simply things are cheap, because the product lineup is just globally competitive at this point in time.
Yeah, I would say the EV product is not just cheaper on a ticket price perspective, but also better because of the better software experience. We do see a strong product strength, affordable price, as well as a software experience. Nice touch would make China EV product for a good start on the global arena. We are conscious about increasingly more complicated trade environment, but in-market supply, as we talked, could be a meaningful way to mitigate the midterm risk. So starting from the good product, but building the consumer trust and channel could be a long march, which might take time. So I would say export at the beginning, but eventually localization across the region and build the consumer and branding traction would be a tougher job. So for good start, but many execution hurdle to be checked down the road. Not without obstacles, but product and pricing and the whole strength package looks quite attractive at the moment.
Yuqian Ding, fantastic insights and really an evolving story here still. Head of China Audits Research at HSBC Shanghai Securities, joining us there out of the mainland. Right, just ahead, the economic miracle in China might be ending, leaving the President Xi Jinping with a challenge really none of his predecessors actually faced, given where China is in its development cycle. More on our big take just ahead. This is Bloomberg. The Chinese economy has been hit by a series of blows, including a real estate collapse and a trade war with the U.S. Now, this is certainly presenting a fairly unique problem to economic officials and the Chinese president, Xi Jinping, who really, unlike his successors or predecessors, cannot bank on economic strength to underpin support. Now, this chart, coming up on your screen shortly, shows that real disposable income growth, this is growth, not absolute numbers, from 1978 up until last year as we pan, show that incomes are still rising, but under Xi, gains have actually been at the slowest since the late 1980s. Now, it's a function of a growing and mature economy. Question mark. The property crisis is also hammering household wealth. For more context on our big take today, our Asia government and economy correspondent, Rebecca Chung-Wilkins, has been looking into this and joins us right now. Rebecca.
Thank you, David. So for this story, we looked at these two big data sets, the IMF data set on Chinese GDP growth, that's across the horizontal line, and we also looked at data metrics from varieties of democracy on freedom, so things like press freedom, academic freedom, so on, which is the vertical line up here. And essentially, we looked at how this changed over time. And when you overlay these two data sets, you see quite a striking picture of how freedom and growth has evolved in China over the past 40 years. So if we come to the Mao Zedong era, just before the reform era of opening up begins, you can see we end up in this place over here where freedom is really quite constrained, growth is really very weak as well. But as we move into reform and opening up under Deng Xiaoping, you can see that growth starts to expand in quite a big way, and as growth expands, we also see on here the expansion of freedom, social freedoms. Now, under Jiang Zemin, these levels stay roughly the same, so you can see this trajectory on the blue line here. Under Hu Jintao, we then start to see the beginnings of a slowdown in growth and the erosion of some social freedom. So the line coming down just a little bit here. Now, if we fast forward to 2023, under Xi Jinping, we see that China has come almost full circle as growth slows and Beijing clamps down on social freedoms. So this is where we hear right in 2023, almost very close to the levels here where Mao Zedong finishes and ends his era. Now, of course, it's important to say that the base level of living standards for Chinese people is much higher under President Xi, but this return to constrained freedoms also tells us something about how Beijing is handling the challenges of this post-boom era.
Yeah, in fact, we also have some numbers on this too, Rebecca. Speaking of economic constraints and also social freedoms, right? So we have data here showing that 80% of protests in China last year were actually linked to economic issues, right? Livelihood, unpaid wages, property pressures, two known challenges there as well. These are figures, by the way, from the Freedom House in China. This is the Dissent Monitor. As you can see, 80% are because of economic issues.
Now, Rebecca, you've spoken to a lot of people for this story, obviously. Who were they, first of all, and what did they say?
So we spoke to really people across, up and down the income ladder, everyone from mutual fund managers, commodity traders, entrepreneurs, but also window cleaners, people who are taking on extra work as DD drivers on the weekend and so on. But one story that sort of struck me was Mr. Huang. He's a commodity trader who struck out on his own a few years ago when his province loosened rules around trading energy. And he was originally very optimistic. He sort of had these boom years in the lead up to COVID. He bought a Tesla Model X. He bought a really expensive apartment in the trendy Nanshan area and Shenzhen. But the last few years, he say, have been even tougher than in COVID. He talks about his friends deciding to cancel or postpone decisions to have children, for example. He talks about his friends and other businesses getting trapped in this cycle of debt and not being able to manage their debt loads as well. And for him particularly, factories that he sells energy to are worried about locking in these long-term contracts because they don't know the prospects of their demand exports. So margins for him are down to negotiating for 0.001 kilowatt per hour. Those are these sort of incredibly thin, razor-thin margins when it comes to negotiating these deals.
No margin for error.
Exactly.
Quite literally.
Yeah, right.
This brings up the big sort of question on the social contract, right? Deliver growth, deliver prosperity, and things will remain stable, for example. Is that social contract to some extent being questioned at this point?
Yeah, I think this has always been the debate. Political scientists sort of sometimes talk about this as performance legitimacy. Essentially this idea that the promise of a better life, these improvements in wealth and so on, have underpinned the legitimacy of the Chinese Communist Party for a long time. Now that certainly isn't beginning to collapse. We're not seeing a breakdown in that exchange, although we do see more of these incidents of economic protests. They are not sort of coordinated or nationwide. They're quite limited, sporadic in nature. But we are sort of seeing some of those signs start to fray. And we get that a little bit in some of the sort of disillusionment from people that we spoke to on the ground. And this concern that they are sort of wedging their heels in, preparing for a tougher era of frugality ahead.
Rebecca Chin-Wilkins, fantastic reporting there, of course, our Asia government and economy correspondent, and that's barely the surface of really this big take. So just catch it, of course, for our Bloomberg clients here on really how China is navigating the slowdown in this economy. Subscribers can read all about the big take on your terminals, and also we have a podcast on this as well. So NA Big Take takes you to the actual function where you do, of course, see the actual text, and also you can listen to the Big Take Asia podcast out today. iHeartRadio, Apple Podcasts, and also Spotify. New episodes are dropping, of course, every Wednesday. Plenty more ahead. The China Brief, to be more specific. This is Bloomberg.
And welcome back to the China Show. Here's your China Brief, a look at what's making headlines in national newspapers and online. Well, the Securities Times cites the National Development Reform Commission, or NDRC, saying the Chinese government is preparing to reveal the first batch of projects funded by the long-term special bonds. China first started selling the notes last Friday, and Beijing plans to issue those special bonds for several consecutive years. Meanwhile, Shanghai Security News says Premier Li Qiang has called on the financial sector to serve the real economy. Vice Premier He Lifeng also asking officials to prevent and control risks in sectors such as property and local government debt.
Yeah, meanwhile, then when you look at the People's Daily, that's the Communist Party's official mouthpiece here, has, well, devoted quite some real estate here, an entire page to criticizing Taiwan's new leader, Lai Ching-te, and suggestions of the island's independence. Now, one of the articles quotes Foreign Minister Wang Yi, describing Taiwan's independence activities as being the greatest threat to peace in the Taiwan Strait. Now, speaking of Taiwan, it's also been a very hot topic across Chinese social media this morning, 2 days certainly after that inauguration. So let's bring Min Lo, our China correspondent, to bring us full circle and really these conversations. What reactions are you seeing so far?
Well, I think the timing is very interesting because on Inauguration Day, we actually didn't see very extensive coverage of the ceremony itself on Chinese media. And in fact, Chinese social media, Weibo, had censored several hashtags mentioning that event. So I have friends living in China. They tell me that their local friends, many of them were not even aware that this was taking place. But then several days later, we now see this deluge of articles criticizing Lai Ching-te on Chinese state media. One of the most outspoken is, of course, the Foreign Minister Wang Yi, calling Lai Ching-te scandalous and a disgrace for betraying his nation and his ancestors, saying that this reunification of the motherland is unstoppable. That's, of course, after Lai had made reference in his speech that he's willing to engage with China, but on an equal basis, with neither side being subordinate to the other. But, of course, this is something that is unacceptable to China. The China State Council had said that Lai is full of lies and deception, that he is trying to pursue independence with the help of foreign forces.
Steve, I'll bring you in here. Really, as a part of the conversation, you literally just got off a flight last night to cover this story, of course, in Taiwan as well. Talk to us about context, big picture, and, of course, the protest we're seeing.
Well, sure. I think what we're seeing is an attempt by the opposition, Kuomintang, the KMT, to use their one-seat majority in the Legislative Yuan to perhaps, dare I say, undermine the opening days of Lai Ching-te's presidency. Of course, he is more of an advocate of de facto independence, and that's where Beijing was picking up on what Min just said, that his speech, now they're calling it the May 20th speech, that essentially delineated the lines between independence and non-independence, and he basically, his tone of his speech, according to Beijing, was more in line with past statements from him, which he has moderated, but more along the independence theme. So in these protests, they're coming from DPP members as well, because they see the KMT, the two opposition parties, the KMT and the TPP, kind of teaming up in the Legislative Yuan to kind of undermine any mandate that Lai Ching-te might have in the opening days of his administration.
All right, great context, Steve. Min, thank you so much. Min Lo, there, China correspondent. Well, we'll leave you with a brief look at some of these beauty stocks gaining in China today on the back of this report that maybe the Guangdong province provincial health officials might be adding some treatments to approved cosmetic surgery categories. Yeah, there we go. Beauty is sometimes surface deep. Kidding. This is Bloomberg.